They're blaming the Bitcoin crash on the usual headlines: ETF outflows, market correction, whale liquidation. But none of those explain why the crash hit this hard, this fast, and this emotionally for everyday Americans. Because the real reason Bitcoin is crescendescent, even about Bitcoin, it's about you, your money, your confidence, and a quiet shift happening inside the US economy that nobody wants to say out loud. And you can actually trace the moment the crash began to something that happened far outside crypto. It started the day Meta announced major cost cutting while doubling down on AI. It intensified when Zunder Musk slashed staff again and warned advertisers about a turbulent 2025, and it exploded after the latest Federal Reserve update, where Jerome Powell danced around inflation like a guy pretending the house isn't on fire. These events have nothing to do with Bitcoin directly, but they explain exactly why people are running out of the market. Hi, my name is John, and I'm an ex-banker who turned into a YouTuber. And today, I'm going to tell you the part nobody on CNBC, Bloomberg, or crypto Twitter is saying because they either don't know or they don't want to say it publicly. Let's start with a story from inside banking years ago. When tech companies would tighten their spending, wealthy clients would instantly move money into safer assets. Not because they hated risk, but because they knew what came next. Layoffs, consumer pullback, corporate spending freezes, a decline in liquidity when big tech breathes in. The rest of the economy exhale when big tech panics. The rest of the economy collapses, and today, the same thing is happening but louder. Americans are dealing with shrinking savings, higher credit card balances, and rent increases that look like they were written by a cartoon villain. The average 35 to 50-year-old is not thinking about buying the dip, they're thinking about paying for groceries, insurance, daycare, and a mortgage that's double what it used to be. Bitcoin didn't crash because people lost faith in crypto. Bitcoin crashed because people ran out of financial oxygen. Contrarian truth, Bitcoin didn't fail the market. The market failed Bitcoin. Let me show you exactly what I mean. When Powell hinted that interest rates would remain higher for longer, the stock market shrugged. But crypto investors heard something different. No fresh money is coming anytime soon. Real wages aren't keeping up. Layoffs are rising quietly. The cost of living is compounding faster than investment returns. And if you're between 25 and 50, you're living in the most financially squeezed generation in modern US history. So when things tighten, people sell what's liquid, and Bitcoin is the most liquid asset many Americans own. That's the hidden driver. Let's move to the insider story, the one almost nobody knows unless you worked in finance. During market stress, wealthy clients don't sell Bitcoin first. They sell risk assets in a timed sequence, starting with the easiest assets to offload without triggering taxes or penalties. Crypto is tax advantaged if you've been holding it for over a year. No early withdrawal penalties. No 401,000 restrictions. No employer plan lockups. No vesting periods. It's fast liquidity. So when the economy tightens, Bitcoin becomes the easy button. And once the selling begins at the top tiers of wealth, it cascades because the majority of crypto holders copy the moves of people with more money. This is why every crash looks the same. Whale sell, funds rebalance, retail panics, but the true spark wasn't a technical chart pattern. It was the economic pressure cooker happening across America. Let's zoom into a real-world example. Remember when Apple announced slowing iPhone demand in the US? Wall Street didn't freak out. But consumer behavior did because the message was clear. People aren't spending like they used to. That single signal told insiders what was coming. If Americans can't justify upgrading their phones, they're definitely not throwing $500 into Bitcoin. This is why Bitcoin crashed. Not because of the technology. Not because of the blockchain. Not because crypto is dead. But because of shrinking consumer confidence. Now, let me show you the surprising insight most investors miss. Bitcoin thrives when two things happen at the same time. Growing liquidity and rising optimism. Today, we have the opposite, shrinking liquidity and rising fear. That's a recession dynamic even if the government avoids using the word. This is the silent recession, and it hits risk assets first Let me give you an insider analogy from banking. If cash is oxygen, then assets are fire. When there's plenty of cash floating around, the fire grows. When cash gets tight, the fire doesn't slowly fade, it collapses instantly. That's what happened to Bitcoin. But here's the part that's never discussed. Bitcoin crashes are not signs of weakness. They're signs of pressure in the larger economy, and every single major Bitcoin crash in history has lined up directly with a liquidity squeeze to a 1-3 federal taper signal. 2018 rate hikes and credit tightening. 2020 global panic. 2022 rate explosion. 2024 and 2025 inflation resurgence plus consumer weakness. Same pattern. Different headlines. Now, let me give you the tactical playbook simplified, so anyone can use it. First, understand this. Bitcoin is not an investment. It's a liquid defensive asset. It rises when the system breathes. It falls when the system chokes. So here's what to watch instead of crypto news. Watch us consumer credit delinquencies. When they rise, Bitcoin gets weaker. Watch job cuts from Meta, Amazon, X, Google, and Apple. When tech trims fat, liquidity disappears. Watch the Fed's tone, not their numbers. When Powell gets vague, markets get scared. Watch the US savings rate. Under 4%, Bitcoin struggles. Watch major fund rotations. When institutions move to bonds, crypto bleeds. Here's the part that matters most. Bitcoin's technology didn't change. Bitcoin's promise didn't change. Bitcoin's value to the future didn't change. What changed is the financial stability of the people holding it. And here's how you stay ahead of the next cycle. Use Bitcoin crashes the way insiders do. As signals. As indicators. As pressure readings for the broader economy, because Bitcoin doesn't just fall randomly. It falls early. It's the canary in the economic coal mine, and if you understand that, you're already smarter than 90% of investors. The real reason Bitcoin is crashing is simple. The American consumer is under pressure. The tech sector is signaling slowdown. The Fed is tightening its grip. And liquidity, the oxygen of all markets, is running thin. When confidence returns, liquidity returns. And when liquidity returns, Bitcoin always responds first. Until then, don't panic. Don't follow retail emotion. Follow the system. Follow the cash because the market isn't crashing. The liquidity cycle is resetting, and those who understand the cycle always win the next phase.